Well, all right, let's take a look now at breaking down all this market action today. We're going to bring in our guest, Julian Brigden, Macro Intelligence 2 Partners co-founder and president. Thank you for joining us today. So as we're seeing, the markets seem to be digesting what they might see from the Fed, that quarter percentage basis point hike. Should they be worried about anything else? Are they too comfortable now, just knowing that that Fed rate hike is coming?
Well, clearly we've got Ukraine, right? That's still an ongoing problem. We're not getting away from that anytime soon. And then in terms of the Fed, I think I would say that it's probably the best telegraphed 25 basis point rate hike that we've had in history. I don't think anyone will be surprised about that. But I think you have to go beyond that and you have to start looking at actually what the Fed says in terms of Powell's press conference, but also in terms of their forecast that you're going to get from the staffers. I think you're going to get quite a big revision to core PCE up for this year and next. Yes, they will always have it dropping back down to target because it's always going to drop back down to target. But I think there'll be quite a material increase. And I also think you're going to see higher dots in terms of their forecast of rate hikes. I don't think you're going to see this as a particularly dovey Fed. I know the market looks, and the equity market is pretty oversold at the moment, so maybe the market will try and look through it. But and we'll try and build a base as long as we don't get a further deterioration in events in Ukraine. But this is not a dovey Fed. This is a Fed, I think, that means to materially to continue, starts off gradually because there are uncertainties, but needs to materially raise rates over an extended period of time, every single meeting, until they get the desired slowdown in growth, or until, which is frequently the case, unfortunately, something breaks.
Julian, you started to answer my next question there, which is how the markets would have to react to a higher dot plot from the Fed, and especially considering the fact that you've already had such a stark reaction and movement to the downside in anticipation of what was already a highly telegraphed decision coming forward. So now this places more emphasis on future meetings and how quickly that rate of hiking may be. What are some of the sectors that could be hit the hardest, even in the interim period of that next hike?
Right. I mean, I think we started to see it. I think one of the things that people forget is that even before Ukraine became a thing, we'd already seen the market under quite a lot of pressure. And the area that was most under pressure was the area that arguably I think is most overvalued given its performance from the 2020 lows. And that was mega cap tech. Right? Mega cap tech has started to materially underperform. I think even if you look at it today, we've got some nice little bounces, but yesterday's drops created some gaps in the chart. So it's hardly surprising that we're seeing some sort of rebound there. But I still think, to me, that looks like a sector that is massively overvalued still.
Julian, given that tomorrow is a given from the Fed, how many rate hikes do you forecast for the year, and how many do you believe the markets have already baked into the numbers we're seeing?
So I think what I would say about this is we forget there are two tools that they have. Rates are one, and the second one is the balance sheet. And personally at MI2, we believe that the balance sheet is actually far, far more powerful. In other words, it's the quantity of liquidity in the system, not really the rate that you pay for that liquidity. So I think, earlier on this year, we had got to, or sort of pre-Ukraine, we got to the point where we were pricing in almost all the heavy lifting assumption that it would be done by rate hikes. And it struck us that that was probably too many hikes being priced in. But that doesn't mean that they won't remove accommodation. I just think, we might find out that we get to sort of 4 hikes and then we try and withdraw liquidity. And as we've seen in the past, the market doesn't react very favorably to that. I think that, to me, is why I'm not putting all the emphasis on rate hikes. I'm looking at what happens to this balance sheet. That, to me, is far, far more important than rates.
And as you mentioned, with one eye on what the Fed is doing, but also, of course, with the ongoing conflict in Ukraine, you've talked about 2 scenarios in this case, de-escalation and an acceleration of violence and the impact that could have. What are the potential market implications that you're bracing for?
So, obviously, we all hope that it's deceleration on many different levels. But I think if you try and break it down into those 2 camps, deceleration or acceleration, I think when you look at asset classes and you lump things into roughly three groups, so you look at fixed income and currencies, those are very, very difficult to trade because you could end up with extraordinary binary outcomes. If you're looking at the euro, we get an acceleration of events and the euro is under pressure. We get a deceleration and the euro bounces, and sort of the same thing in the fixed income market because we still have this ongoing inflation problem. Equities, I think, becomes a cleaner trade. Don't get me wrong. I think if we saw a deceleration, we'd see a very swift bounce in the equity market. But I think they would run into a phalanx of central bankers on both sides of the Atlantic who materially need to raise rates. So I think on an acceleration, the equity market just goes straight down. You just got to have the guts to be able to sell into weakness. And I'm afraid to say that I think on a deceleration, the market would bounce, but it'll run into very hawkish central banks. And so I don't see us going to new highs. I do see us increasingly beginning to build what has typically been a major top in the market. And that is one of those big rolling tops that we see, that we saw ahead of, say, 2000 or 2007, 2008.
Julian, while we have you here, we do want to weave in some breaking news that is just coming across within the past couple minutes here. Sarah Bloom Raskin reportedly withdrawing her nomination to the Federal Reserve Board of Governors. That news coming days after the Democratic Senator Joe Manchin would not support her nomination. Just more brief background on this. She was nominated to serve as the vice chair for the supervision of the Board of Governors of the Federal Reserve, and that nomination of Lisa Cook and Philip Jefferson to serve on the Board of Governors of the Federal Reserve as well. Julian, just very briefly, want to get your reaction to this, given some of the annexation for Sarah Bloom Raskin as seen as further developing the Fed, and for the Biden administration, what they had seen in her role potentially adding to the Fed as well.
I think it's really unfortunate that we've got these nominations perceived as so political. I think all of these individuals are extraordinarily good within their space. But, this is the nature of politics in DC, and the perception, not always the reality, I think, about how the other party sees that people are trying to twist and turn and change things so that they have permanent advantages. You've got it in terms of the Supreme Court. We're going to try and get it in terms of the Fed. I don't think that's necessarily fair, but that's just the nature of the beast. And I think Sarah Bloom Raskin was seen as being too radical for a number of people in DC.